What is market capitalization? In this video you will learn how to determine how large or small a company is, what market cap is and how to calculate it, the three groups companies can be placed into, what the advantages and disadvantages of each group are, why it is important to diversify your portfolio. There can be certain opportunities that you can find with companies of different sizes, and this lesson will introduce you to the different ways you can find an edge of companies that have a certain size. First of all, we will explain what market cap is and how you can determine the size of a company. You can determine how large or small a company is by using a common method called market capitalization to calculate its value. It is also known as market cap for short. Market capitalization is the value of a company based on the total value of all its outstanding shares. Basically, it shows you how much it would cost to purchase the entire company at the current share value. When the company's share price rises or falls, the market capitalization follows suit. The basic formula for calculating market capitalization is outstanding shares multiplied by share value. For example, if a company had 100,000 outstanding shares and they were worth $10 each, then the market capitalization would be $1 million. A company's individual share price does not tell you exactly how much that company is worth as a whole. A company with a lower share value may actually be worth more than one with a higher share value, if it has more shares outstanding. Market cap therefore allows you to make a quick decision about a company, telling you how much a company is worth, without having to go into too much detail, looking at a company's balance sheet, equity, and debt value. Investors can work out the value of a company based on market cap, which allows them to group certain companies together in order to diversify their investments. There are three groups that companies can be placed into: small cap, medium cap, and large cap companies. Let us take a look at the first group of companies called small cap companies. These companies usually have a market value of between $500 million and $2 billion. However, this is not set in stone. Small cap companies are normally new and are not followed as frequently or are not as widely recognized as larger companies. One of the big advantages of small cap companies is that their share prices are usually much cheaper to buy. With the exception of periods of economic turmoil, small cap companies can outperform larger size companies due to their greater growth potential. Traders and investors often look at smaller companies during periods of economic growth because confidence is higher and they are likely to increase their risk tolerance for greater returns. Investors very often like to take a personal approach when it comes to buying or selling shares in a small company. For example, let's say you are a customer of a new company and have seen their products or services on offer. You may get a good insight into how the company operates and what the potential is for future growth. This insight could give you a reason to buy or sell shares in the company. As an investor or trader, knowing that a small company's share price is often far more volatile due to lower liquidity can make it easier to pick up potential changes. For example, a sudden increase in price action can be a giveaway that other people are interested in the company's shares. So what are the disadvantages of small cap companies? Because these companies are usually new, they are normally associated with higher risk, as there is a greater chance of them going out of business. Small cap companies also pay little or no dividends to investors, as they need to reinvest their profits back into the company to allow for expansion. As a trader, you may find it difficult to buy or sell shares at the price you want when trading in these companies, as the liquidity is lower because fewer people trade them. Let us now look at the second group that companies can be placed into. These are called mid-cap companies. These are companies that have a market capitalization of around $2 billion to $10 billion. Occasionally, you will find that some mid-cap companies used to be large-cap companies that have had a decrease in their share value. However, these companies still have the potential for growth. One of the advantages mid-cap companies have is that they are generally seen to be safer than smaller cap companies to invest in, as they have less potential to go out of business. Because these companies are larger than small cap companies, they usually have larger levels of funding available to them. This can be a big advantage in troubled economic times. Mid-cap companies also have great growth potential through product development and customer acquisition. Unlike small-cap companies, mid-cap companies are more likely to pay dividends on a more consistent basis. Mid-cap companies can still hold many benefits that smaller firms do. For example, when the economy is doing well, medium-sized businesses also do well due to their growth potential. As a trader or investor, it is easier to analyze medium-sized companies as their balance sheets and financial statements are generally much smaller and easier to read than larger companies. This helps you determine what new products they may be working on and what the future may hold, helping you decide if the company's shares are worth purchasing. One of the disadvantages of mid-caps is their growth potential can be lower than small-cap companies, as their growth potential can become stagnant. Similar to small caps, medium-cap companies are more exposed in an adverse economic climate, and unlike larger cap companies, the shares are less liquid, which can be a big disadvantage to traders. Let us now look at the third group that companies can be placed into. Large cap companies, also known as blue chip companies, are the big guys, with a market capitalization of over $10 billion. Due to their large size and greater access to funding and cash flow, large cap companies are generally seen as the safest investment for people looking for a stable return, as they pay dividends more consistently than the small or mid-cap companies. These companies are also more secure in volatile economic environments. As a trader, you will find that liquidity in large cap companies is higher, which results in lower volatility, resulting in better trade fills. A large company is normally able to invest further into developing products that already have a brand behind them. When these companies announce a new product or technology, there is usually a positive response, which is reflected in the share price. Trying to find an edge when looking to trade shares in large cap companies can be difficult, as there is little in the way of public information that will not be available to everyone else. When looking for an edge to determine which large cap companies to trade, you will usually have to analyze the company in depth to determine if the company is undervalued or not. Sometimes this can be enough, because some traders are more willing to analyze companies than others. For example, large cap companies produce very large and complicated company and earnings reports. A trader that will go through this information in depth may determine something that shows the company is undervalued and find an opportunity. Due to their massive size and having usually reached their ability to acquire new customers organically, large companies have the least potential for significant growth. As a trader, you will find that because these shares are very popular and generally expensive, you will be less likely to purchase large quantities of them. Note that although large cap companies are seen as a more stable and safer investment, there is still some risk involved when looking to invest in them. There is no guarantee that owning shares in these companies will offer stable returns. For example, banks were once seen as stable large cap companies. However, since 2008, many banks have gone out of business or seen their share price collapse. You can look to diversify your portfolio among companies of different capitalization to avoid your portfolio being heavily weighted in one section. Owning a high percentage of large caps would limit your potential for growth, while owning a high percentage of small cap companies can be too risky. As a precaution, you should never look to trade or invest in different shares in only one aspect of the market. As a well-balanced approach, one could look at having a portfolio of large companies that provide consistent returns, as well as a portfolio of mid and small cap company shares for growth and large gains. In this lesson, you have learned market capitalization is the value of a company based on the total value of all its outstanding shares. It shows how much it would cost to purchase the entire company at the current share value. It is calculated by taking the outstanding shares of the company and multiplying them with the share value. There are three groups that companies are grouped into. To show the market capitalization, these are small cap, mid cap, and large cap companies. Small cap companies are worth between $500 million and $2 billion and have excellent growth potential. However, they are normally the most risky to invest in. Mid-cap companies are worth between $2 and $10 billion and are seen as the middle of the road in terms of risk and growth potential. Large-cap companies are worth over $10 billion. They are often seen as the safest for investors in terms of risk. They also normally pay regular dividends. However, they normally hold the lowest growth potential. It is always best to look to diversify one's portfolio across small, mid, and large cap shares.